Hi everyone, welcome to today's video. So on this video, I'm going to help you understand systematically why the Hindenburg issue is not over yet and what are some of the key points that you must remember. This video is especially important if you have invested a lot of money in the Indian stock market right now. Now the reason why I'm saying Hindenburg issue is not over yet, take a look at this graphic. It shows that Hindenburg has built its short position for September to November, right? In that zone it has built. Today people are celebrating, you know what, Indian stock market did not fall, and it is great that Indian stock market did not fall. I myself has invested a lot of money in the Indian stock market. I don't want it to fall. But the situation is not regarding today. The situation is regarding what happens around November, right? Because that is when massive short positions are built on the Indian market by Hindenburg. So that is the explanation that I'm going to give you, right? Additionally, I will also speak about the fact that how does exactly a stock price move? What is the risk to different type of stocks like Adani stocks, HDFC stock, all that stuff. So I'm going to have that conversation with you, and I'm going to explain this entire very complicated story in very simple points. So let's go point by point. And also on that note, that since we are very worried about the market fall, we should equally be worried about the job fall in the Indian job markets right now. The unemployment rate is rising in India like anything. It is hitting close to 9% now, which is a very bad situation. So during times like these, you can learn high impact skills like artificial intelligence. And in order to do that, I would highly recommend you to check out the masterclass that is being organized by Growth School. This masterclass is usually a paid masterclass, but for first 1000 people who sign up using my link, this masterclass will be provided for free. On this AI driven masterclass, you will learn about personal brand building. You will learn about data strategies, salary hike strategies, solving bigger and complex data problems by using AI within a few minutes. Now, this workshop is useful for anyone who is coming from a freelancer background, business building background, entrepreneur, software engineer, marketing professional. So do check out the workshop. It includes several bonuses. The class will happen at 7 p.m. So in case you are interested, you can check out the links in the description and comment box. So with that said, let's move over to the main video. So the first key point that you must understand is the entire Hindenburg, Adani / SEBI chairman saga, right? So the first round was between Adani and Hindenburg, and in that round, Hindenburg shorted a lot of Adani stocks. They probably booked profits in it. I don't know. I'm not privy to that. And that thing happened in January of 2023. For example, if I just show you, so here is where the Hindenburg short was, right? And till date, Adani Enterprise has not recovered. Similarly, a few other Adani stocks, since the time Hindenburg has shorted Adani stocks, they haven't yet recovered. So this is a very important point that we must be aware of. So this was round one between Adani and Hindenburg. The second round started literally like 3-4 days back when Hindenburg came out that, hey, we are going to sort of do some dhamaka in the Indian stock market. And then eventually it turned out that, they were targeting the gun towards the SEBI chairman, right? And they said that, okay, there are like some allegations against her that she diverted funds to a foreign entity, vagera baatein. I don't want to rehash the case because this is a very politically sensitive case. People are taking sides. I don't want to get into the middle of all this. So I will leave the judgment up to you. Hindenburg has issued their entire report. The SEBI chairman and her husband has explained what their viewpoint was. Then another round of allegations were made by Hindenburg, and then a lot of clarification back and forth is happening, right? So this is where the case is. We as investors should not be taking political sides here. So let us focus on the macroeconomics, the investing part of it, which brings us to point number 2, right? And this is a very important point, and the point has to do with the fact that exactly how do stock prices move. Now people are not understanding how exactly stock prices are moved in a particular market. We assume that, boss, when good results come, the stock rises, and when bad results comes, the stock falls. That's a childish understanding of the stock market. So in the next 1.5 minutes, let me give you the practical explainer as to why do the stock prices move. And for this, you need to understand two concepts. Okay, so the first key concept is a graph called as supply and demand curve or supply and demand graph of the stock market. So it looks something like this, right? So this is the supply of any stock or any asset, for example, Nifty 50, and demand curve is downward sloping. Okay. Now, typically what happens is that the supply of stocks usually remains the same. It's not as if that HUL tomorrow will suddenly increase more number of stocks or more number of outstanding stocks, or Adanis are going to usually increase their number of outstanding stocks. Please notice the word usually. Of course, the stock supply can also be increased, but generally it does not go up dramatically compared to demand. So wherever the supply curve and demand curve meets, that explains the price of a stock, right? So this, let's quote it P1. Now what happens is that in order to move any particular stock price, the demand of the stock is played with. For example, Hindenburg came out and said, "ये सब घपलेबाजी हो रही है." What is the goal of Hindenburg? Well, the goal of Hindenburg is to move the demand, reduce the demand of stocks, or in general, the Indian market, जो भी demand आ रही है, they want to kill it, or they want to reduce it. So if they are able to successfully reduce it, right, then this demand curve will shift leftwards, and we will get a new intersection point somewhere here, and that leads to a fall in price, P2. Okay, so this is how a stock price change. Now there are 2-3 related points. For example, there could be a massively overvalued stock, and I will show you the example also. Now that stock's fair value should be, let's say, 150 rupees. Okay, you are watching it today and it keeps on going up. It goes to 250 rupees. Now, can you definitely say that it will fall from this point? The short answer is no. An overvalued stock can become hyper overvalued if the demand of the stock can be increased. A classic case study is that of Wari Renewables. So take a look at this. This literally looks like a pump and dump, and the stock was taken up like 30 times or 40 times, right, from its basic price. There was no improvement in fundamentals, but the stock went up. Why? Because the demand of the stock was managed, right? This is first very important point. Second key point, our second key example is that of HDFC Bank and Kotak Bank, right? For example, right now you might be scratching your head. Take a look at this graphic. You will see that in the last 4 years, the revenues of HDFC Bank, Kotak Bank have doubled, profits have doubled. There is no issue with the stock, but the stock is moving in a range. Why? Because the demand of the stock is not going up. This is the insightful point that you should know. That brings me to a related point about the supply and demand of the stock, that how exactly is the demand of a stock managed or moved, right? So for this, you need to understand the concept of counter buyers, right? So now what is the meaning of counter buyers? So let me explain it by showing you the actual trade book. So what you will notice is that, see, this is ITC stock. So on the left side, you are seeing the buyers, right? Buyers. And on the right side, you are seeing sellers, right? Red wale sellers. Okay. And this concept is called as order book matching. So let's assume that the price of ITC currently is 265. Okay. And you want to sell, right? So you are one seller and you have one stock. So you will place one bid to sell ITC at 265 rupees. Now, if you get one buyer at 265 rupees, then this trade is executed, right? And you get money in your account and all that stuff subsequently. जो clearing process होता है, right? So we are not getting into the technicalities of it. Now, the reason why a stock price falls is this, that hey, now you are trying to sell ITC at 265. You have one stock, and you don't get a counter buyer. There is no one who is willing to buy this stock. So what will happen next? You will place the bid, कि अच्छा ठीक है 265 पे नहीं तो 263 पे. Then you again don't get a counter buyer. You keep on doing that exercise, and at 250 you get your one buyer to buy this stock. So this is called as order book matching, that your order got matched at 250 rupees, and therefore the price of the stock fell from 265 to 250, right? So this is the meaning of falling of the stock. This was a technical explanation that I wanted to give you, and understanding these salient points is going to make you a better investor. So in case you are interested in learning more about such fundamental points, I explain it on my member community. Excellent reviews about the community so far. So in case you want to check it out, I will put the link in the description and comment box. I also teach international investing. I am personally putting a lot of my money for diversification purposes outside India now. Any sensible investor should be hedged, right? We are retail investors. We don't know what is going to happen, what news is going to come, all that stuff. So I teach that style of investing also. So in case you are interested, you can definitely check it out. So anyways, coming back and now explaining this concept at a market level in India, there are two very important trends that are happening in India right now. In fact, there are 2-3 trends, so I'll explain it very, very quickly. The first key trend is that FIIs are not buying into the Indian market too much. This is not my opinion. This is what is happening for the last 3-4 years. So I will show you the data. You can see year-wise data of FIIs. So FIIs mean foreign institutional investors. These are foreign players, right? So in 2024, they are net sellers and they have sold very aggressively. In 2023, again, FIIs have sold the Indian market. They bought the Indian market in these 3 years, right? But अगर आप इनका total करो, the first 2 tabs, and इनका total कर लो, the second tab, right? Then you will see that they are in the last 1, 2, 3, 4, 5, almost 5 years, FIIs have been net sellers or they have not bought the India market. Very, very important point, and you must understand this. Okay, so this is fact number 1. Fact number 2, then who is actually buying it and who are the counter buyers in the Indian market? It is the DII. Now, what is the meaning of DII? DIIs they are like HDFC AMC, Nippon AMC, all the fund managers and all that stuff who are domestic institutional players. They are the ones buying the Indian market. Okay. Now comes the question that, hey, where are they getting the money to buy the Indian market from and why are they buying the Indian market? Okay, so for this, you need to know fact number 3, which has to do with SIP contribution. So for example, this is the entire chart. Take a look at this, that the total SIP contribution in October of 2016 was 3,434 crores. This has gone almost 5 times, right, in October of 2023. So in almost 7 years, 5x growth. This is massive, right? Now, why am I talking about SIP? Because the way this model works is that, see, you are retail investors. You will run your SIP every month, every first of the month, you will give like 50,000 rupees as investment to your fund manager, mutual funds, whatever you invest in. This is given to companies like HDFC AMC, right? This is given to companies like Nippon. This is given to companies like Edelweiss and all that stuff. They are DIIs, right? They pick your money, right? And then they end up buying or creating those counter buyer positions that I was telling you about, right? So this is very important fact. And if you relate all these 2-3 facts, let me summarize because I'm getting to something interesting here. Number 1, foreign institutional investors are not buying the Indian market. Number 2, DIIs are the ones who are actually creating counter buying positions in the Indian market and supporting it whenever it falls. And number 3, the SIP contribution is rising like anything, and there has been exponential growth of SIP investments, which brings us to very interesting prognosis of the Indian market. And this is something that you need to be very, very careful about. And the fact is that, see, if for some reason there is shock in the market, that for example, retail investors are not very comfortable doing SIP or they slow down their SIP, or if there is any kind of panic in the market, in the SIP market in India, because retail investors are very flimsy, right? I mean, they are not like that well versed with investing world. They have not gone through a lot of hardening process per se. Itne experience nahi hota, right? So for them, they are much more volatile, right? So they can leave the market at any point in time. So in case there is a world oriented shock, Indian markets are going to get hit very, very badly. This is not my opinion. This is what the data tells us. This is point 2. Because FII money is not coming to India, to be honest, the FII type of stocks are not giving a run up. Now, these are stocks like HDFC Bank, Kotak Bank, right? Clean companies. Why am I telling you these are FII type of stocks? Because FIIs, what they do is that they do hedging, right? So hedging ka matlab hota hai that, for example, they are buying HDFC Bank in the cash market and they might be selling HDFC Bank in the futures market. Why? Because they are hedging their position. वो यार हजार crore, 2,000 crores, they will buy it in one go. They cannot be sitting on so many naked positions per se. They have to hedge it. They have to protect or buy a type of an insurance. Otherwise, they can go bankrupt, right? So they can only do this FNO on limited set of stocks in India. And this is one of the reasons why HDFC Bank and Kotak Bank type of stocks haven't really given a run up, because last 3-4 years, FII money has hardly come to India. So this is fact number 1. Fact number 2, that there are certain types of stocks that DIIs prefer to buy, right? And for example, small cap, mid cap category is entirely or almost entirely supported by DIIs or domestic institutions, not by foreign institutions per se, because the risk profile of these stocks is very high. Okay. The summation of these 2 points is that if you combine these 2 things, ki dekho, whenever the market correction happens, small and mid cap are sitting on a keg of powder, right? And they can go down very aggressively. This is point 1. Point 2, certain stocks where there are no fundamentals, but they are still being bought by DIIs because of wide variety of reasons. I'll not go into them. They will fall like anything. Okay. Whenever the correction happens, I have zero interest in politics. I'm simply trying to tell you and teach you these points so that if this logic makes sense, you can reorganize your portfolio a bit. See, small and mid cap, you have to be confident that, market is going to survive. Nothing bad is going to happen. Fundamentally weak stocks, you should cut positions, not because they cannot rise. They can continue to rise. अब यार SIP अगर ऐसे बढ़ती चली गई and DIIs keep getting money and they keep on pumping in like small cap cap, mid cap stocks, then they can keep on rising. But right now, there is valuation risk in the market. Now, what is the meaning of valuation risk? Let me explain that also by using some technicals. So valuation risk means that you can see that this is the long-term trading channel. We are somewhere here at the support, right? Now, if this support gets broken, there is another 10% fall. Now, 10% fall is for the broad market, the large caps, but there is at least a 20% fall for small and mid caps here, right? So this is the valuation risk that we are running right now because the market is at an all-time high, and any kind of global shock, for example, if there is some war that breaks out, right, and it gets escalated, then these are all global risks that is there. So therefore, at this stage, you should focus on reducing your valuation risk. Why? Because FIIs or foreign institutional investors are also exactly doing the same, right? They are going to safer markets, right? Safer markets. Now, what are safer markets? Safer markets are where the valuation risk is less. That's A. Second, there is more investor trust. Now, there is not an easy way for me to explain this. So I'll use a very simple example. What constitutes as a good economy, right? So for example, let's say that we are talking about our domestic tourism. Now, people used to come to Goa. Now, because a statue has been built in Gujarat, now those same domestic tourists start going to Gujarat. Do you think that this is real addition to our economy? The short answer is no, right? That money would have anyways come to Goa, but instead of coming to Goa, now it is just simply going to Gujarat per se, okay? So this is not like real increase in prosperity or leading to any economic strength per se, okay? So this is point one. But on the flip side, consider, for example, Burj Khalifa, right? Now, Burj Khalifa in Dubai, it attracts a lot of foreign tourists. They come with it, carry their national currency from Sweden or like India, they convert it into dirham and put this into Dubai economy or UAE economy. Now, do you think that in the second example, the economy is getting strengthened? The short answer is yes, right? And you don't require like massive understanding of economics to understand this basic simple point. So similarly, in the stock market or for any economy, it is very critical that we bring foreign money in, and that requires transparency, that requires trust. For example, again, I will speak from UAE's example. So UAE real estate has been giving very good returns. Why is that? Because if you go and check on this website called as Bayut, right, you will see that every single transaction that happens in real estate has been put on a blockchain. You can track that which apartment in which locality got sold for which price, and what was the square feet or square meter of that apartment. That is the level of transparency. But do you feel okay transacting in like Indian real estate? No, there is massive opacity. You don't know like, how much black, white, green money, pink money is there and all that stuff. No idea of rates, whatnot. So there is no transparency. What do you think foreigners do? Do foreigners really buy real estate in India? No. So very few foreigners would be buying it. Similarly, if similar situation starts happening in the Indian equity market, we will entirely be dependent on your SIPs. That is the simple point. You give your SIP till the time your SIPs are going, markets will keep on going up. Whatever random stocks need to be purchased will be purchased from that perspective. And whenever it corrects, whenever there is any kind of external shock, you are holding a very high sovereign risk, right? So this is the precise problem that we are witnessing right now. What is it that you should keep in mind as an investor? 3-4 things I have started doing personally myself. Number one, I have started to internationally diversify. Over the next 1 year, I will diversify approximately 50% of my portfolio outside India. That seems like a more reasonable, diversified bet. This is absolutely critical. This is point one. Point two, you need to be prepared to deal with volatility. Now, what is the meaning of volatility? Be prepared for that 20-30% correction that can come very fast and furious, because our market right now is retail driven, right? And retail people are very ephemeral. They are very volatile, so to say, right? वो कुछ भी कर सकते हैं वाली चीज़, right? So there is no head or leg or thought process behind it. One bad piece of news can impact us really badly. So this is the problem that we are witnessing. And I think given this reason only that SEBI is coming so hard after FNOs and whatnot, right? So this is point two. Point three, please do not display your nationalism by buying specific private companies. That is not the sign of nationalism. Please use your brain that a businessman is not equal to India and India is not equal to a businessman. All the profits that company is making, they are not putting it back in the economy per se. Okay, so this is a simple point that I will tell you. Valuations make sense, भाई जाके खरीद लो, right? आप अपना घर पर बेच दो, right? And buy that stock only, that is not a problem. But buy things on fundamentals, because the problem in terms of not buying things on fundamentals is that you will buy some random company like Wari Renewables. Again, take a look at this. When it starts falling, when it corrects in a day by 20%, you would not know what to do with it, right? So given all these points, go on fundamentals, study the fundamentals of a stock, diversify your risk. Next 6 months can be volatile and you need to figure out a way to preserve your investments accordingly. I hope you enjoyed this conversation. If you did, do press the like button and I'll see you soon.